Namaste to one and all. As we know, climate risk is one of the biggest risks which we as insurers and reinsurers face on a daily basis. India has the world's third largest climate risk exposure. 12% of our land is flooded perennially, 50% drought prone, and in this we have got the third largest crop insurance program in the world, covering crores of farmers, various states, 15 plus agroclimatic zones. This scheme of PMFBY since 2016 has evolved into one of the most tech-driven, sophisticated crop insurance schemes wherein actuaries can do amazing stuff. And we can have discussions after Sarthak ji presents the overview of the scheme to us. So over to you, Sarthak.
Thank you, Siddesh. So, good afternoon, everyone. I'm Sarthak. So, let's start with about the scheme introduction. So, as Siddesh ji mentioned that, PMFBY is the flagship program of Government of India, which is aimed to provide relief to the farmers in case of a crop failure because of some listed and named perils. So, starting with this, some, timelines of the PMFBY. The scheme got launched by our Honorable PM on 18th February 2016. And in April 2016 itself, the previous schemes that we had, the MNIs and the NAIs, got integrated with the current PMFBY scheme. Then moving on in 2016 itself, in Kharif 2016, we implemented the unified package insurance scheme, which was aimed to provide not only crop insurance to the farmers, but a lot more products which can be used by the farmers, which included life insurance, which included livestock insurance, and many other products. Unfortunately, due to some operational constraints, the UPIs, which we call it as, could not succeed, and we had to roll back the scheme. The idea was to get back into the scheme with some more features. But moving on in 2017, when the scheme actually completed 1 year, 1.5 years, we saw that the premium got reduced and the coverage got increased. When I say the premium got reduced, it does not mean that the number of enrollments also went down. Instead, the number of enrollments went up, but the premium rate reduced, maintaining the sustainability of the scheme. In 2018, we launched the mobile app Crop Insurance for farmers. It was a one-stop solution for the farmers to actually see any kind of its policy conditions, named perils, anything that the farmer want to see on what all perils he or she is covered. Then moving ahead in 2019, taking the feedback from multiple stakeholders, there was a need that we need to enhance the scheme coverage, enhance the scheme conditions for the betterment of the farmers. So in 2019, we started with the process of restructuring the operational guidelines, which actually helped the scheme run. So in 2020, after the completion, I think it took 1 year for us to understand, from the public, from the farmers, from the stakeholders, on what all advancements do the scheme need. So in 2020, we came up with our revised operational guidelines, which was aimed at easing out the issues that farmers or the insurance companies were facing in the scheme. One such example was that, previously, prior to 2020, we had a compulsory, insurance cover for the loany farmers. When I say loany farmers, those are the ones who actually take loan or crop loans as part of the KCC and MIS scheme of Government of India. They were, they did not have the option to move out of the scheme. If they are taking a loan, it means that they have to get it insured. So, we actually eradicated that, and we made it voluntary even for the loany farmers. In 2021, as Siddesh ji mentioned that, this is a tech-driven scheme. We wanted to have some more, technological interventions in the scheme. We wanted to have more, technology being used to assess the claims, assess the yield. So we, came up with a lot of, technology interventions. Some of them were YesTech, Winds, you will see in the next slides. And, we also wanted to optimize the crop cutting experiments. The way we can assess the yield, we wanted to optimize, we wanted to use smart sampling techniques for that. So that happened, starting in 2021. In 2023, again, last year, sorry, we actually made some more advancement in the scheme, made some more changes in the scheme, and we also, issued a new revised guidelines again. The next year is a very interesting year for all of us. So, we are going with a mega tender cycle. The first mega tender cycle happened in 2023. In that, almost all the states, barring some states, had a mega tender of 3 complete years. Some have even had for 2 years. But the idea is to have more, competitive rates for the state government and for the farmers, and obviously for the governments. Moving ahead, to understand the scale of implementation, we are right now at the 18th crop season. So we have 2 major seasons for the scheme. One is the Kharif season and other is the Rabi season. So right now we are at the 18th crop season. And 27 states at once or more, have actually participated in our scheme. And we have been, we have insured more than 75 crores farmer application. And for those applications, we have insured more than 19.5 lakh total sum insured, which is a huge number. And in terms of the claim payments, we have settled more than 1.7 lakh crores, claims. And right now, we have 20 impaneled insurance with us, in which we have 5 public sector undertakings and 15 private players. And we have, for the distribution and for the enrollment of the farmers, we have 1.7 lakh bank branches, who are actually helping us enroll the farmers. Apart from that, in terms of CSCs, which is another wing of Government of India under the Ministry of IT, we have more than 6 lakh enrollment points, which help us to enroll the farmers for the betterment of this, for the betterment and for the scheme. And I'm proud to announce that, we are globally the largest program in terms of the farmer participation, and we are globally 3rd largest in terms of the premiums that we are charging for the farmers. To understand more on the PMFBY product structure, so from the complete start to end of the crop cycle, that is from sowing till the harvesting, we are insuring the farmers for any kind of losses or calamities that can occur. Starting with the sowing part, we have a cover called prevented sowing, wherein, if we feel that the actual yield will not be at least 50% of the normal yield for that area, we apply a claim of prevented sowing, and the 25% of the sum insured is actually paid to the farmer, and the rest, and the policy then ceases. Then, starting from germination to maturity of the crop, we have multiple covers you can see on the screen. The very first and the basic cover is the area yield index cover. This is the, the base product of PMFBY that we have. And the idea here is to, if the actual yield is less than the threshold yield, which we, define at the start of the, year or the season, if the actual yield is less than the threshold yield, it means that there is a shortfall. And when there's a shortfall, we cover the shortfall percentage and we pay to the farmer. Then comes a lot of add-on covers, which the state government have the option to choose. The very first, add-on cover is the localized calamity. So in localized calamity, at a local farm level, if there is any kind of, peril happening, example, we have inundation, we have unseasonal rains, we have floods, we have, cyclonic rains. So in that case, if a farmer has suffered some losses in his localized land, he or she can actually intimate the claim, and we will assess that with a survey, and we will pay out the claims. Then comes the mid-season adversity. So, mid-season adversity is more on a widespread area. A similar kind of, perils that were happening in the localized, if that happens on a widespread area, in that case, the complete district or the GP or the Gram Panchayat or the block or the insurance unit, which we are insuring, is declared to be, under the mid-season adversity, and the whole area or the farmers in that area will get the claim. So the difference between localized and mid-season is more that localized is more towards a farmer, intimating the claim on his or her personal land, and mid-season is more of a, area-based approach, wherein, we pay the claims to all the farmers in that area. Then comes the, the post-harvest cover. It is another add-on cover. So, once the crop has been harvested, and it is kept in a cut and spread condition, over the field, in that case, we provide a cover of 14 days, after the harvesting of the crop. In case of any cyclonic rains, any peril, which is a named peril, because of that, if the losses occur, so we actually pay that losses to the farmer as well. So, in the, I think previous 2 slides I mentioned about YesTech, which is a technological intervention of the scheme. YesTech basically is a remote sensing technique, which we use to assess the, the yield of the crop, using satellite images. So, for this, we have partnered with, ISRO, ICAR, SAC, And we have done pilot studies in around 100 districts, before implementing it on a full-fledged, mode. And we had an expert committee which actually told us about what kind of models can we choose into this. So we have some example, like we have semi-physical model, we have AI and machine learning, and then we have some crop health index model as well. So this kind of pilot, this kind of complete Yes Tech program has been regulated by MNCFC, which is the National Crop Forecasting Center. It obviously comes under the Ministry of Agriculture. And we have some technological implementing partners, we have some Mitra agencies, we have some insurers, state government who are actually a part of the Yes Tech framework. Whenever this framework, whenever these kind of reports are generated, we send that report for validation as well. So whenever the technological implementation partner is actually working on some report, they will share with the MNCFC, they will share with the state government insurers. There will be a thorough validation of that, and post that it will be used to actually blend the yield. So when I say blend basically means that there are two methods actually right now, basis which we can actually calculate the yield of the crop. The one and the traditional method is the crop cutting experiment method, which is a physical mode method, wherein the people will go on the farm, they will cut some farmland in particular shapes depending on the crop. Then they will assess the dry weight, the green weight of the crop, and then the yield will come up. That is a statistical measure to estimate the crop yield. Another method is Yes Tech, which we are using satellites. We want to see what is the yield coming up. And to arrive at the final yield, we are now blending the approach. We are taking the weight of Yes Tech as 30% and the weight of crop cutting experiments as 70%. Since we are in the pilot stage, once we are more confident on our approach, and once we see that yes, the Yes Tech yields are somehow matching with the crop cutting experiments, and it's close to that, we will be increasing the weightage to the Yes Tech as well. But state like Madhya Pradesh in India, they are completely dependent on 100% on Yes Tech for the yield estimation. Yes, next initiative is WINDS. So WINDS basically stands for Weather Information and Network Data Systems. So I know it's an era of climate change, right? So we want to understand how climate is affecting the crop yield. So for that, we right now have two specific things. One is the AWS, which stands for Automatic Weather Station, and one is the ARG, which stands for Automatic Rain Gauge. So right now, we have around 20,000 AWS network in the country. And the idea is to have 3,500 more AWS. AWS actually calculates or records the temperature, humidity, and all those stuff. The rain gauge will actually record all the rainfall that is happening. So rainfall, ARGs right now we only have 13,000, but the idea is to expand and have approximately 160,000 ARGs across the country. And this data when we are making a single repository, the world's largest repository of climate data in India. And basis on these kind of data that we get, we will be collaborating. We have already collaborated with IMD, which is the Indian Meteorological Department, and we have created a WINDS committee, which actually assesses the data that we are getting from all the weather stations, whether is there any kind of anomaly, any kind of issues with the data, and how we can optimize the data or the AWS more to get better data. Yes, and so basis of that, the overall idea is to have at least one AWS every 10 kilometers. And the second idea is to have at least one ARG every 2 kilometers, right? Which for a country like us, which is so huge, it is a good milestone, because we will be having the hyper-local weather data. And this obviously, being an actuary, I can say that, it will be helpful for us to assess the crop loss better. And if we can assess the crop loss better, we can price it better. Yep. So in 2019 and 2020, there was a time, it was a hard market, and there was a time, when a lot of crop losses occurred. And because of that, when we actually came to a tender process, we saw that, maximum companies were trying to leave the crop insurance, and they were not quoting, in the bidding process. And even those who were quoting at a very high rate, because, the losses were so high. So, there was a time that, Government of India thought that there's a need for some kind of intervention wherein, we can somehow support the insurance companies as well, in this hard market, and we can somehow, participate in the risk or get the complete risk transferred. So for that, we had, introduced 3 models, which we call it as AITM models. AITM stands for Alternate Risk Transfer Models. So the very first model, that we came up with was the cup and cap 8110. Under this model, it's a very small horizon for the insurance company. Under this model, so when I say 8110 or 6130, it's 80. This number stands and denotes the loss ratios. So for the cup and cap 8110, the condition is that if the loss ratio goes beyond 110%, then all the losses beyond 110% will be borne by the state government. And if there's any kind of premium surplus, because the loss ratio is less than 80%, the premium surplus below 80% will be gone back to the state government. So, the state government is acting as, as an insurance company in the sense that, they will be sharing the losses and they will also be sharing the profits. The next model that we had was 6130. Under 6130 model, the similar concept remained, but the numbers changed. That is, the loss ratio beyond 130%, was shared by center and state government. And the premium surplus below 60% was again shared by center and state government. The third model was the profit and loss sharing 0350. It is sort of somehow complicated model, because we have different brackets under which, the sharing of the losses and premiums will be defined. So this model has not been used by anyone as of now. The more common and more famous models are the cup and cap 8110 and 6130. Under 8110 model, Government of India does not participate in the risk or in the profits or in the premium surplus, 8110 has been adopted by around, I think, 5 or 6 states, which includes Andhra Pradesh, Karnataka, Maharashtra, Madhya Pradesh, and the state of Uttar Pradesh. 6130 model has been adopted by the state of Tamil Nadu, Rajasthan, and the UT of Puducherry. So the actuarial methodology for pricing, actuaries play a very great role, in administration of the scheme, in the pricing of the scheme, and making the scheme more viable, for the farmers. So the role of actuarial team is, to have the risk assessment, analyze the likelihood, and probably, the impact of risk factors over the crop yield. Apart from that, we have been doing a lot of historical data analysis. We have been checking the crop yield, how it has been, how the weather patterns have affected the crop yields as such, and what is the frequency and severity of the crop losses. The frequency and severity is important to understand, how the claims have actually occurred in the past, and if the claims have occurred, with how much severity they have occurred. Then also, since we are working, for the benefit of the farmers, our role is also, to make the scheme more sustainable in the long run, and we need to balance the coverage and the premium, and obviously the affordability. Because, this scheme is for the public good. It is for the farmers' benefit, and, we need to take care of the fact that, the prices should not go very high, that it is not, easy for the farmers or for the government to, spend from their budget, and, the coverage should also not go down. Apart from this, the role of actuarial team is to, help the ministry understand and estimate the expected budget that they would require, for running this scheme. What kind of budget will go, over the expenses or, over the scheme branding, what kind of budget will go for the premium payment, the premium subsidy payments and all. Over the pricing techniques, I think this is very much common, for the industry. So we have 2 approaches, one is the bundling cost approach, and the second is the frequency severity approach. Bundling cost approach is majorly used to assess, if you remember, I mentioned that we have an area yield index cover, which is the base cover. So for the base cover, we have been using the bundling cost approach to measure the yield, the shortfall in the yield, and basis that, what is the expected loss cost that is coming up. This is normally done at crop and IU level, and the sum insured that we normally estimate or assume is sort of the scale of finance that every state government is issuing for every crop. Scale of finance basically include the input cost that the farmer is getting to actually grow that crop. In the frequency severity approach, apart from the yield index cover, we have 4 add-on covers, which I mentioned in the starting. To assess that, we need to see what kind, since not every state is adopting all the add-on covers, we need to assess that, at what level and which state is getting the most losses from those add-on covers. So for that, we follow an approach of frequency severity, loss estimation for these crops, wherein, we are just trying to price the events, which have all these add-on covers. And obviously, the expected losses is nothing but, the frequency into the severity. This is again a very common slide for the actuarial community. For coming up to an office premium, we need to see what is the historical burn cost and the expected loss cost based on the add-on covers. Apart from that, the data that we receive is not that homogeneous in the sense that, so if we want a data at a village level, we might not have a data at a village level, right? For the yields, we might have at a block level or a revenue circle level or, maybe at a district level as well. So that kind of data heterogeneity is something that we need to account for in our pricing. So we are already doing that. Apart from that, we also take care of the fact that there are some costs and expenses and obviously the profit margins, for the scheme, which we need to take care of. And obviously the local consideration, specific, consideration for any, specific calamity prone or anything for that particular local area is what we need to account for in the premium. So here are some key actuarial observations. Yes, the very first thing is the market share in terms of the sum insured. So, right now what we've seen that, the public sector undertaking companies, the PSUs, are taking around 43% of the total sum insured, under the scheme, and obviously the private sector have more as compared to PSU, which is 56%. In the public sector, we have AIC as the major leader, into this, followed by Oriental. On the private side, we have SBI, SDFC, Reliance, Shema, and Bajaj, who have taken up the bunch of good business for PMFBY. And please note, all figures, all these observations are part of the Kharif 2023 mega tender cycle that we had last year, and the next tender cycle is expected to be in 2026. So if we compare the burn cost versus the actuarial premium rate, so here is something very interesting that you will see. For most of the states, you will see that burn cost is higher than the premium rates. So the insurance company have been quoting a lower rate as compared to the expected loss cost or the burn cost. And specifically for the cup and cap 81 states, wherein you would see that the loss horizon or the risk horizon for the insurance company is very low, because beyond 110% they have no liability to pay. Right, so the risk horizon is very low, and there you will see that the premium rates is comparatively low as compared to burn cost. Another interesting thing that you will see here is that hilly states comparatively have a better burn cost as compared to the other states, and which suggests that there is a lower incidence of losses in these states. Comparing the sum insured category, so what we did, we wanted to see if we use the method of percentiles to see what kind of sum insured, what amount of sum insured is coming in what category. So we have divided that into high, medium, and low, and we see that with respect to sum insured, 37% business, the sum insured is coming into high category, followed by the medium category, which is 34%, and then the low category, which is 28%. And if you now compare the premium rates for these categories, you will be surprised to see that the maximum premium rate is coming for the medium category, which makes sense because they are trying to diversify their premiums and the risk. And then followed by the low category, and the high category of sum insured has the lowest premium rate. Then, so we basically have some different indemnity levels depending on the crop risk. We have an indemnity level of 70%, 80%, and 90%. So here you will see that, at 70% only, the APR, or the premium, APR stands for actual premium rate, that is more than the burn cost as compared to the 80 and 90, where you will see that the burn cost is high and the premium rate is low. Comparing the same thing over two different seasons, you can see that for Kharif, the premium rate is higher, as again, for the 70% indemnity level, as compared to 80 and 90, and the same or the similar trend goes for the Rabi season as well. Yes, talking about the major 5 crops. So in terms of acreage, these are the 5 crops which are major for us. This is wheat, cotton, paddy, soybean, and maize. And this acreage is the area which is insured and not the area which is grown, guys. So this is a catch here. Then, for these major crops itself, you can see that 68% of the sum insured is coming for the major crops, which is a huge amount for us. And, if you compare for these major crop itself, the APR and the burn cost, you would see that, the difference between APR and burn cost is the maximum for cotton and soybean. And for other crops, it is not that significantly, they did not differ significantly. But for cotton and soybean, it is the major difference that you can see. What is the way forward? So yes, being an actuary, we are now thinking to develop some specific catastrophic modeling exposure rates. We want to model catastrophic, over the country and to see how we can, include the effect of catastrophes into our premium pricing. So for that, as Siddesh mentioned that, we have 15 agroclimatic zones in India, and PMFBY right now is covering in 13, agroclimatic zones. So for each and every agroclimatic zone, we want to develop a region-specific exposure rate, to assess what kind of catastrophes happen at what level and in which agroclimatic zone, which, peril is occurring. Apart from that, as I mentioned about winds, so we will be using the data for winds as well to incorporate our local weather patterns, crop data, to see how we can match winds with the catastrophic modeling. Then, this will help us ensure accurate premium pricing and, some tailored coverages as well, like region-specific coverages if we want to provide. Example, we want to provide, a cyclone cover to the state of Andhra Pradesh. We can have more data from there, since it's a coastal area, we can, plan things and plan the scheme better. Another thing that, we want to intervene here is we want to include the role of reinsurers. I just need 2 minutes. We'll include the role of reinsurers, to better price and, to, enhance the models that we currently have so that, we can have a better and optimum pricing, which will actually impact the budget of the government and the farmers as well. So that is the overall idea. I will just quickly cover it up. So, reinsurance pricing, working with reinsurers to refine the model is the next step that we are planning for the scheme. Apart from that, something similar to catastrophic modeling, we want to now risk and risk map all the districts in India. The idea is to have, at what all are the risks in every district of India and how we can, use that data for the pricing purposes, use that data for the analytics purposes, use that data for, enhancing the scheme coverages as well. And, this is something that we are, again, looking for. Yeah, thank you. I think that was it. Do we have, yeah, please.
Yeah, thank you, Sarthak ji. So, when we think about actuaries as the first data scientists, I think there is no other line of business in the Indian industry today which works with more data than the crop insurance industry. There are petabytes, not terabytes of data when it comes to the satellite-based climatic models. And Sarthak ji had shown you those 5 models. And these are quite advanced uses of AI/ML techniques, which I believe actuaries can contribute a lot to. So just for posterity's sake, I know time is up. Let us have one question from the audience and then we'll wrap it up.
Yes, yes, sure.
Yeah. One question? So let me ask that question because the audience is
sure,
not... okay. So when you talk about actuaries working with these satellite images, you at UNDP are doing a lot to encourage the use of these models to see how these models are. How can people from our institute get involved? Do we support research projects? How, if at all the institute needs to proceed with a research project with UNDP, how do we proceed?
Yeah, sure. So for that, obviously IAI has a greater role, and in terms of how actuaries can support the satellite, the satellite image. Now, how actuaries can play a great role here is that, we want to assess the models, right? And modeling is something which is, in the blood of the actuaries. So, the idea here is to model the losses well, to match the losses that are coming, from the satellite images with, the actual losses which are coming from the crop cutting experiments. So, in terms of research area, I think, IAI has a greater role to play. And I would suggest, members from IAI to, come up to us and we will be happy to collaborate and see, what best modeling techniques we can use. Apart from AI, ML, if we have any other, factors we can consider, I think it will be good. Yeah.
So,
There's one question.
yeah. Sir.
This is something, an experience I had as an actuary about 4 or 5 years back of the crop insurance. I think there might be similar experiences in the past from others. The 3 or 4 problems that I confronted in those days, I'll tell you. One is, of course, the risk of denying claims. In certain states, it was impossible. You can see that frauds were happening right in front of you, but you can't simply deny the claims. Politically, it is impossible. So now, that is a risk which is you can't measure. That's one point. Second point is that reinsurers were refusing to cover certain states. Again, because of the political risk. Thirdly, between us, there is also a lot of corruptions. There are people demanding money cut out of that. Again, you cannot, this is not an actual point, this is a problem with administrator. But again, I'm saying that this is about 4 or 5 years back. I know that a lot of improvement has happened because of the modern drone technology, so it is more, it's more possible to sort of find out evidences. But even then, some of these risks, particularly the reinsurers' refusal to cover some of those things, were there a problem in those days. Again, I'm saying that things might have improved. So I want to like to have your comments on that.
So just to answer that, there are certain things I agree. There were some issues of, denial of claims. That is a risk for this. But, we have come up with more, frameworks. We have, revised the guidelines to make it happen. Second thing, we have a grievance management, as well. We call it as Care PH, wherein the farmers can go have the grievances with us, and Government of India is actually monitoring all the grievances now. So that is one achievement that we made in the scheme. Regarding the reinsurers' participation in the scheme, I think that is the idea. If reinsurers don't want to work in a particular state, that is the reason that the actuaries will now play a key role, in managing stuff and managing the models with the reinsurers, and make them convinced about the scheme and how we can insure the maximum insurance companies against the against this. So I think that is another agenda that we have, and we want to achieve it in the coming years. Definitely.
Otherwise, and third and final question, which I didn't want to mention, in this business, if you make a profit, then the entire political opposition circle will say that this is a, there will be some that well-known companies will
Yes,
be
it has
saying
been
that.
the case very recently.
So if you make loss, everybody is silent. If you make profit, then you are actually fleeching the farmer. So this sort of political risk is also something which is deterring global players, particularly in sort of joining this game.
Yes, I agree. The idea is to have an optimal, profit margin for the insurance companies, so that should not be very much high profit, so that the farmer does not get the benefit. But for maintaining the sustainability of the scheme, I think we need to have a balance between the loss, the profit, and the claims. So, for the long-term viability of the scheme.
Yeah, so very valid points brought by sir. Some can be discussed out loud, some cannot be discussed out loud. So thank you, Sarthak ji.
Thank you.
So we can close the section, I think.